We're here to empower high-income earners to gain back control of your time through financial independence and stop trading your time for money and start letting your money work harder for you.
And hey, if you want to meet other high-income earners on their FIRE journey, join our High Income Earners FIRE Facebook group. Every month, we'll have guest speakers and we'll share about what our team is currently working on and allow you to share what you are working on with other high-income earners.
Hello, everyone. Welcome back to High Income Earner FIRE podcast. I'm your co-host, Cody Ye. Aline Prague is somewhere in the background, in the virtual background world. She will probably come back as a guest speaker soon, but not today. However, we have a really special guest, actually two guests, strong couple, power couple, long-term real estate investor in the real estate investing space. But what really differentiates them is that they have a vertical integrated business. So it's not everything outsourced. They are really strong with operation, continue to become stronger. And they start with flipping small multifamily and recently moved to US for some multifamily, bigger building investing. So I'm really excited to bring them on. So let me welcome Jose and Khadija.
Hey, thanks for having us.
So tell us a quick background story. How you guys get into real estate? How you guys started until now?
Yeah. So, sort of loaded questions. It's like quick, synopsis.
1 minute.
I'll try my best.
1 minute. Elevator pitch.
Yeah. So we've been investing for, I'd say, almost 15 years now. We started just like everybody else with single family properties. I think that we always knew that there was something more. There was something we both wanted. We were both entrepreneurs in some way. We wanted more than just our 9-to-5s. And so, we started buying properties, not in the best areas. We weren't educated at the time. We were buying cheap properties. We didn't have money. And then we gradually, obviously educated ourselves and evolved into buying in better areas based on more economic fundamentals. Mm-hmm. So we started in Rochester, New York, actually way back when, moved into Windsor, Ontario, and then liquidated all of that bad stuff. At the time, it was bad stuff, what we had. And then moved into better economic fundamental areas, which is where we really excelled, Hamilton, Ontario, Oshawa, Ontario, and then a lot of the other areas in the GTA that we continue to invest in. And we were primarily buy and hold investors, but we also obviously pivoted and created more active income through real estate too. So we've done flipping, a little bit of wholesaling. We've done some development work. But I'd say the bread and butter of our strategy and where we've actually made most of our wealth is through the buy and hold. So we've pretty much not sold anything after we exited Windsor and we started buying. We never sold. We kept everything. We've accumulated over 150 units in Ontario now. And I think what allowed us to win, quote unquote win, is because we took operations in-house. So like you mentioned, we're vertically integrated. We have our own property management arm to our business. We manage everything in-house. We do a lot of heavy renovations, heavy value add in all of the stuff we purchase. So we have our own construction management in-house too. So it's all kind of like an ecosystem where stuff goes through it. And that's where kind of the flipping came in too, because we already had the ecosystem set up and we were able to just pump the flipping through there and create, obviously flipping is a different strategy. That's more of an income generating strategy. So yeah, that's it in a nutshell. And obviously now, as times have changed, we've also pivoted and started doing more business south of the border, buying larger multifamily assets and being involved in a different way in operating those.
Mm-hmm. Anything Jose want to add?
Yeah, okay.
Yeah, you know what? The last few years have been amazing with the Ontario real estate market. Obviously, the appreciation was super strong, and then last few years I was saying to myself, what's next? Either I look for another market in Ontario or in Canada, or should I move across? Look at opportunities south of the border, and I said to myself, there is a little bit of a pain to get started in south of the border because of cross-border taxation and legal structures and all of that. But long term, I need to figure this out because that's where most of the opportunities are going to be, right? That's when I started educating myself and learning a lot more about syndication and how to bring on equity partners to close on larger multifamily assets.
So, okay, first off, when do you guys quit your full-time job?
So I left my job almost 8 years ago.
8 years ago. Okay, that's 2014. Yeah. How many property you guys have, or was the income source at that time?
Yeah, so I also got my real estate license around the same time, and that was when I was able to transition myself from with the income portion. Yeah. So I used to work with primarily investor clients because we were heavily buying investment properties. We were educated on the different markets and the numbers, and kind of being a advisor and a coach to the clients that I was working with. So, and then until she transitioned after we had our first kid.
Yeah. So we had kids. So Jose quit his job just before our first kid was born. So that was another conversation with the family, and people like, what are you guys doing? Like, your wife's pregnant. She's going to go on mat leave. You guys are about to have your first child, and what? You're quitting your job? But, there's no perfect time. I think that we were at a juncture where our business was just so busy with even like the rentals and the things we were doing. And it was either he had to quit or he was going to get fired at some point, right? Because,
what was Jose doing before you quit? You're an engineer, right?
Yeah, so I was working for, I was an engineer working for a large engineering and construction company. And that's kind of how I developed that passion for construction and building things.
And what about you, Khadija?
Yeah, so I was working too. I had a corporate career. I have my master's in environment, health, and science. I worked for some large corps. I worked for the TTC for a while. I used to be in oil and gas before that when I first started my career. And I worked for the government most recently, which is, I think, what caused the exodus faster. It was so frustrating, like just the bureaucracy and just not being, I was like, what am I doing here? Right. Every day I was like, what am I doing here? Because, you're just not able to realize your full potential, really, no matter what you do. So, and, at the same time, I knew I wanted to have kids. Having kids was always really important to me. We had a hard time having our first kid for various, health reasons. And when he finally came, it was like, am I going to be going to work every day and leaving my kid behind? And that was just it just wasn't an option for me. So I think that all of those factors compounded at the same time to just create this, like, we're going to have to figure this out. We're going to figure it out. And we did. And I think once you are, not to say that you should leave your job with like no backing. At that point, we had already bought 20 properties. We had 20 properties. Most of them
Windsor?
were duplexes. No. None of them were in Windsor. We sold everything in Windsor. Everything we owned at that point was in Hamilton and in Oshawa. Gotcha. So we bought very aggressively over like, I'd say 4 years or 5 years. We were doing the BRRRR strategy. Like,
when was that?
I think we started the BRRRRs in like 2010, 2011, maybe in Hamilton or in Oshawa.
Yeah, around that.
Yeah,
time.
Somewhere in that time frame, so maybe 2011 or 20, like around that time. And so we were doing them really fast, and we were refinancing them really fast. And so we were able to accumulate, I think it was around 20 properties. Most of them were duplexes, some of them were singles. And at that point, we were tapped out of our financing anyway, which is what we needed our jobs for. So we were like, okay, well, we can't qualify for any more mortgages anyway. So like, okay, perfect.
Well, A-lenders. Yeah. No more.
Yeah. A-lenders. Sorry.
No, and then we did get into B lenders, alternative lenders, and with the higher rates. And that's when we realized that, we might need to focus on buying commercial properties now. We were at that stage. In between, we had a couple of joint ventures deals that we did as well. But we also started focusing on flipping as well. Flipping market was amazing. Like, obviously the last few years we've had a great run in the market. So,
how many property were you guys flipping per year?
So at the peak, probably around 2 deals per month.
Nice.
Yeah, we were never super high volume flippers, but what we did do well was we set ourselves up just like the wholesalers did. So we had our own landing pages, our own marketing. We were farming our own deals. We were not buying from wholesalers, and we knew the markets or sort of the pockets that we liked.
Yeah.
And so we were farming deals, and we were like, we were getting some crazy deals. We were buying some crazy deals, and we were not always interested in volume. We were all about like our bottom line. Right?
Yeah,
like,
we were, like for us, the most important was the profit margin, potential.
So tell me, what's a minimum? Because my past business partner is actually a flipper, similar volume as you guys, not in the same area.
Yeah.
So it's okay, but like he was aiming for at least 150,000 if he wants to get into a deal. Was that some kind of profit margin you guys were looking for?
Maybe not that high, but I mean, we did make a lot of them, but going into it, we would say like around 75, 80,000 was our minimum.
Yeah.
And then, but by the time, we actually sold that property 6 months later, it was typically more than that, right?
The market was helping, right?
Yeah.
The market was helping. And our other thing was we were never lux flippers. Our after repair value was usually like, we wouldn't do anything typically that was too much over $1 million. And our typical time frame, we like to be in and out fast. Like there's flips we would do in 3-4 months. Our longest flips were like 6 to 8 months in downtown Toronto if we had like a hard project, but we were never typically in a job for very long.
Yeah. More risks if you're in the longer, and if the price point is lower, there's more buyers, right? So it won't sit as long. The risk is overall smaller, and that's very smart.
Yeah, exactly. And the good thing is that we were trying to do the flips because our business model was not to do wholesaling. As we would occasionally do it
one-off thing if you can't take
here,
it.
We don't want to keep something. Yeah.
Because we were very kind of location focused. Because we had crews and relationship with the contractors within kind of 1 hour drive of the GTA. So we stuck with that business model rather than kind of branching out into many, many different areas. And while in the meantime, we were also kind of, buying those or selling those properties, taking the profits and buying apartment buildings.
So you guys were working full time. Both of you guys quit around the same time, 8 years ago. So 2014, then you guys start flipping right away. You guys already have 20 properties, or kind of walk us through that.
No, so from 2014 to about 2018, Jose was primarily he was an agent. That's what he was doing.
Got it.
That was our main source of income at the time. And in 2018, we had twins. Our twins were born. And at that point, we had another decision to make because agent life is not easy either, right? He was
no weekdays night. No weekend.
Yeah. It was very difficult. It allowed us to exit from the corporate life, but it just created another job for us, right? And Jose, at that point, he had started to build out a bit of a team with having agents, but it was never his passion. I don't think there was it was just a source of income really at that time. It was great while it lasted, but it wasn't like, hey, this is what I want to do for the rest of my life. Yeah.
And I typically never worked for most cases, a typical home seller and home buyer. I was primarily dealing with other investors. That was my specialty, right? That was kind of my niche in the market. I was speaking from experience, and I related to investors, so I was able to find them great deals and make sure that they were set up for success. So I kind of grew that business as much as possible without sacrificing too much of family life, and then eventually I kind of knew that I needed to transition out of that. Essentially I partnered with another agent to kind of transition myself out.
You become the rainmaker.
Yes, in a way, yeah.
You become the rainmaker. That's 2018. So that's 4 years ago. So then what happened after that 4 years? You guys already have one kid. Now have the twins. Now you have 3 kids. What happened in the last 4 years then?
Yeah, we started doing more and more flips, and then same thing is using that income and channeling into apartment buildings. And we were doing some large renovations. We would do more than 25 units per year in renovations of those units, as well as our flips. So quite busy, So we knew we could have scaled our flipping business even more, but we were also busy with running these other jobs.
The apartment buildings and really building out our property management arm, right? Because while we were purchasing these buildings, we really had to have, the infrastructure to manage them.
Mm-hmm. So most people said that property management company don't actually make money.
Yeah. And I mean, the intention was never to make money. I don't manage anybody else's properties.
Mm-hmm. Yeah, the main focus was because in the past we've had third-party property management, and we never felt comfortable with having our large property manager, large properties managed by third party, because the same attention to detail was never gonna happen.
You're just a number for them, right?
Yeah,
maybe a bigger number, but still a number.
There's not as much accountability. And I found that there was a lack of good quality property management, especially when you're dealing with, a heavy value add project on top of it. So it was better for us to just have it all in house, and we had scale at that time. Because I would say, beyond let's say 75 units or more, then you're able to hire somebody full-time staff to handle that.
Why is that 75 units so important? Why is it more than that? Then it's worth it to have someone in-house.
I think just the income that it generates too, right? You have to be able to support it in-house. If you have 20 units or something, think about how much it's going to cost you to hire a full-time staff. At that point, the cost benefit, you're going to pay 5% for a property manager, let's say, on your gross revenues to manage your properties. But I think for us, everybody's numbers are different, right? But for us, it sort of made sense after that point. And the lease ups, in the last 4 years, we acquired 4 buildings. In the last 3 years, we acquired 4 buildings, and most of them were heavy value add turnarounds. And so we were leasing up 20 units a year too, right? Mm-hmm. So just the cost of lease up, imagine, and just the selection of tenants is so important in our environment, right? Especially in Ontario. Obviously, for those listening, how difficult the landlord-tenant rules are here, which is why it is so integral to make sure that you're screening your tenants properly, that you have the right people in your buildings, that you have the proper systems in place for rent collection, for arrears, all of that whole entire thing. And if mishandled, the amount of loss that can result is I don't even want to think about it.
Mm-hmm. Yeah, we'll get into that part. I know that's probably a main reason why Jose want to go into US, but we'll get to that part.
Yeah,
we'll get to that, I promise. So are most of you guys have 150 units right now, right? Roughly. Where are they located right now? Is it all in Hamilton, Oshawa, and Atlanta, Georgia? Or
so those 150 units don't include anything Atlanta. The Atlanta is a separate portfolio. These 150 units are just in Ontario. We actually don't have partners on our properties. They're all owned within the corp. And we typically are in Hamilton, Oshawa. We have a building in Cambridge, and we have a property in Brantford. We had a few other things in a few other small cities, but we've since those are gone from the portfolio. So right now it's just primarily these 4 cities that everything's located in.
Mm-hmm. That's great. So now that you guys have 14 years of experience, and you guys, I invited you guys on because you guys want to have a good balance. You guys have 3 kids, want a financial freedom life. You guys are more set financially, but you guys are still pushing it. So what is that you guys are pushing for? You guys have 150 units owned outright. So 30 years from now, when all the mortgages pay off, I don't need to mention numbers, probably definitely multiple 9 figures, not to mention the cash flow come in, right? Just a net worth is multiple 9 figures. So 8 figures. Multiple 8 figures. Let me take that.
Yeah.
So what you guys are pushing for?
It's funny when everybody asks us this question. I think, okay, so there's 2 things. Obviously, the portfolio itself is a long-term wealth creation strategy. We are finally now at this point where we are able to live off the portfolio very comfortably. Like we do have enough income coming in to live off the portfolio. However, in the past, like when we had those 20 duplexes, I'll be honest, we couldn't live off that portfolio.
Well, I definitely understand. I have like multiple duplexes. I'm like, well, all the money I never taken out, whenever there's a tenant turnover, all goes back into some rental.
Yeah.
Who told me about a $500 to $1,000 cash flow? I want to smash that person.
Yeah. And it doesn't give you that peace of mind, right? Because you know of the swings and the fluctuations. Again, like real estate is slow and steady, and it is very much a long-term wealth. Exactly like you said, like, okay, you know, you have this portfolio, it's going to get paid off. And eventually, yes, there's going to be a great nest egg there. But there still does need to be an active source of income, in my humble opinion. And for us, there always has been. When Jose was an agent, that was the case. And then for the last 4 years, we were actively flipping, and that was a really, really solid source of income. And so now there always does need to be a business in place which generates income for us, which is, you know, part of the package. And then obviously the other part of the package is like, once you do generate, we like business, whatever we do, we want to generate, you know, do it to the best of our ability and generate that income. And then when you do get that income, you know, like Grant Cardone says, right? Like you never keep money in your bank account. You never live off the money that you put in the bank account. So like I make, you know, $200K from a deal or a business or whatever. Am I going to spend my $200K, or am I going to invest it and try to get returns from my $200K? Right. So there is always this need to create this cycle of like generating income and then taking that income and parking it into some kind of a long-term wealth creation strategy. And like, you know, I'm still in my 30s. Like what would I do?
Do you mind if I ask?
Sorry?
How old are you guys? Do you mind if I ask?
Yeah, I'm 38 and Jose's 40. He just turned 40 this year.
Nice.
So yeah, we got married when we were young. I was like, 24 or 23 years old or something when I got married. So we started our life early, which gave us a great kickstart, I think, anyway. And I mean, like I'm 38 years old. Like I have young kids. My kids are looking at me every day, and leading through example is so important. So if I just park my vehicle and I'm like, okay, I'm done. What are they going to see? What are they going to see? Is that, like, oh, the money's just, we're just flowing here. Like mom and dad don't have to do anything and we're just like chilling here. Right. And so like, it's really important for us to see our kids to see that and like to embody that value. And like, I think that this whole idea of intellectual wealth that you pass on to your kids, this generational wealth that we pass on. It's not about money. It's about giving them the skills. And the best way to give them those skills is to show them through example how we live. And, Jose and I, we live a simple life. We want our kids to see that. I mean, we have time freedom and we have a lot of time to spend with them. But other than that, there's really no like, we live a
and you know what, like it's about challenging yourself every single day. Pushing the limits, because for me that's how you keep growing, right? Mm-hmm. It's after a certain point it's not about money. It's about
it's a game.
It's a game, yes, and basically living up to your full potential, right? And that full potential you'll keep stretching that as you
the horizon keep changing.
Exactly.
Keep moving.
and of course there's as Grant Cardone says, right? It's about it's your responsibility to even give back to the world as well, right? It's if you're financially satisfied, it's not enough, because you have the ability to help a lot more other people, and that's kind of why. One of the reasons why we actually transitioned into U.S. multifamily is because we wanted to get a lot more our friends, family involved in our deals. And that we were able to do so because we were creating opportunities for them to put their money to use, right?
Yeah. So since we're mentioning pivoting kind of to the multifamily in U.S., can you tell us about the journeys, about the things that you never told anyone now that you already closed the deal, raised on it?
Yeah.
Was it difficult to raise capital to convince Canadian to give your precious money going to south of the border where they have, people have wild imagination because of the US movie, right? But people actually, right? So how was that?
Definitely was, so this was our second deal that we closed. The other one was in February 2022, but we had it under contract in late 2021. Mm-hmm. So definitely, Canadians are a lot more conservative when it comes to investing. I would say, generally speaking, they have less disposable income, because our living expenses are a little bit higher. Our real estate is pricier. So basically our cost of living is a lot more. So generally speaking, they have less disposable income. And so it takes in when you're introducing a cross-border investment, it even reduces the investor pool even more. But it takes just a lot of education, a lot of trust, and kind of showing them that, hey, these kinds of opportunities are not existent in the Ontario market, at least, right? You're not going to get cash flow and equity growth in Ontario. You're going to get mostly just equity growth, which is great, but it's also more of a speculation. It's not a sustainable business model. Especially now that we're seeing things slow down.
So I'm gonna be the guy that asks all the most common question I think you guys will face. So you talk to investors like, oh, I heard about you can't have an LLC, withholding tax. How do we avoid double taxing? How do you answer that question?
Yeah, you know what? It's there's always a way around it, right? So you got to talk to the right professionals. You gotta get a cross-border CPA as part of your team, and Canada does not recognize LLC, so instead you have to invest in a limited partnership or an LP, because that is a flow-through entity. So, are things a little bit more complicated? Yes, but you got to have the right professionals to talk to, and there's always ways to do business in the U.S. because a lot of other people have been doing it for a long time, right? So it's just about talking to the right people to get the right advice.
Do you guys establish credit in U.S.?
Yeah, we're starting to. Yeah.
Yeah, up until now, we don't have credit in the U.S. No.
But you guys were still buying buildings.
Yeah, so we had to partner with a local American to get that portions taken care of.
Got it. And what's the reason why you guys want to start establishing the credit in U.S.? Because that's more of a personal side of things. Is it because eventually you guys want to move your family down, maybe become a snowbird? Is that the reason, or
you know what, we think that's just giving us options, right? Why not? It's always a great idea to have maybe we want to have a vacation home in Florida at some point in our life, but establishing credit is just one of the reasons, and then that we're gonna work towards getting maybe our visa in place as well.
What kind of visa?
So it's a E2 visa, which is an investor and business visa. Yeah.
I want to come back to the multifamily deal. So tell us more about that deal that you guys can talk about, right? It's already closed, right?
Yeah, it's closed.
Good. So what was that deal like? And you guys say, hey, you have to educate your Canadian investors more. Were they all Canadian investors in that deal?
No, it was not all Canadian. Primarily, it was American investors. So to give you an idea, it was a $18 million purchase price, and we had to raise just over $8 million for this deal, which included contingency and working capital, and with the capex or capital improvement loan as well. So we raised money from portion was from Canadians. A portion was actually we got from private equity as well.
What's the percentage roughly from private equity?
Private equity, we got $2 million invested from.
And why do private equity are interested in your deal? Because you guys, it's your second deal, and they're willing to give you $2 million, and that's like you guys are raising $8 million, so that's a quarter of the whole thing. So why do they want to do that?
Yeah, I mean, those, so I had to make I talked to probably about 15 different private equity groups. And obviously I got a lot of no's. And finally we got one yes, which we thought we were probably not going to end up with, but they came through with it at the end. Obviously, what made it even more challenging is that the rates were changing, so they were getting scared as well, and we thought they were going to pull out, but luckily they, my partner stuck with them, and we actually made myself and my partner went down, and we told them to come down, meet us at the property. We kind of showed them the area, showed them the property, met with the property manager, drove them to these new developments that are nearby. So made them feel comfortable that, hey, we're this is a good, solid investment. And from their perspective, their money is pretty secure because they have a preferred equity position in the property. So
what does that mean, prefer equity position?
So that means is that they're basically second to the senior debt or the lender. Mm-hmm. They're the second in position. Mm-hmm. So they don't have an equity upside on the property. They're getting a fixed return. Mm-hmm. Mm-hmm. So their risk is fairly small, and they also, all of their returns are actually in a reserve account already. So that's just part of their conditions, right? So they're not like they already have their money pretty much upfront. So very low risk investment for them, and it's a great investment in general for their investors because they're it's still backed by a hard asset, and they still we still have to report our performance to them.
Yeah.
But generally speaking, I mean, it's a pretty low risk investment because their returns are already in a reserve account. The only thing obviously they're worried about is the capital, the principal. Mm-hmm.
So how do you compare the expectation from the private equity with the money you guys raised in US compare with the Canadian investor that went on board? How do you compare the expectation?
Yeah, so Canadians are, like I was mentioning, they're very conservative. So they're more like on a limited partnership. So they are, our class of share for them was they get a preferred return, which is 8%, and then they get the upside as well when in terms of when we sell the property. Yeah. So they're your typical limited partner equity investor, versus or equity partner, the pref equity partner, there's no upside for them. They're okay with just getting their fixed return. So it's almost
what is
like
that fixed return that they're expecting?
Yeah, so we pay them. There's a 8% that we pay them annually, and then they have another 7% accrued when we sell the property, or whenever if we refinance the property.
And then how long do you think that horizon will be?
So it's a 5-year term.
Got it. Yeah. So really every year they're taking the 8% and then 7% spread out into 5 years of compounding is maybe 1.5. Fair enough, right? So they get about 9.5% per year. Is that how they look at it?
No. They look at it that they're getting this 8% and then another 7% accrued. So they're getting a total of 15%.
Per year.
Yeah. But you're just not getting paid that 7%.
Unless it performed that, right?
No, only until the end.
So that's still...
there's a capital, what do we call it, a capital event, whether it's a refinance or a sale. That's when they will get paid that accrued portion.
Mm-hmm. So you said there's no upside. Seems to me that there's still upside, but they kind of cap their upside.
Yeah.
Is there anything over like 8% you pay them, another 7% per year, but anything over 15% once you push it back to
anything over return? If we outperform this property and let's say we're making 20%, we get to keep that additional upside.
Cool. And what about the US investor?
US investors are exactly the same thing as us. Or the limited partners, Canadians. So they get exactly the same treatment. They're also an equity partner. And, with they have a lot more additional tax benefits. So that's the other great thing about
1031 exchange. All these good
well,
stuff,
besides
right?
1031 exchange, so actually on our deal we had some 1031 funds as well that came through. But the tax benefits is like, you have something called bonus depreciation. You have because we do a cost segregation study where on the property. So rather than what in Canada we have a straight line depreciation.
Yep.
We have there in the US is bonus depreciation because of a cost segregation study. So you're kind of front loading your depreciation, which is a huge tax advantage.
Yep. Yeah, you can write it all off in the first year, really.
Exactly.
Right?
So
100%.
It will be basically we're creating a huge paper loss, and that's why you don't end up paying any income.
Yes. Is that with all these reasons, I know I study about the US tax structure. It's just full capitalism and just a wonderland. If you really know what you're doing, if you really stick to it, you can make a lot more money and do a lot more varieties of things, right? Just a wonderland. And Canadians, like you said, are safer, more protective, more socialism. But for people that are willing to push, are willing to, grow, Canada is definitely capping a lot of the capability in terms of tax, in terms of legal,
Absolutely.
in terms of even the mentality of things, right?
Yeah. Yeah. And even just like Jose said, opportunity, right? Like that was one of our main reasons to go, because we were at a point where we had capital. We were like, we didn't even refinance some of our buildings because we were like, okay, like we're going to refinance them and then do what? Because there was other buildings that may have been coming up for sale, but we didn't agree with the numbers. And I mean, like, for example, just to give you an example, we just put an offer on a building like a few weeks ago and somebody outbid us like by quite a bit of money. They went in firm. They hadn't seen the building. And quite honestly, like even at the number we were offering, it didn't make any sense. We were kind of like, oh, well, we operate in this area. Like we should be able to do it. It's a long-term asset. Like it's good. But if you looked at it just on paper, the deal wasn't that great. Like the profits weren't that great. And on top of that, I had to turn around like, X number of units. And how was I going to do that? Right. Like I could do it. I know I could, I've done it, but I couldn't bring in, and that's honestly part of the reason why we don't have equity partners in Ontario, because I could not sleep at night. If I bought like a 50 unit building here and I told my investors that in 3 years, we're going to refinance this building because I'm going to have turned around X number of units. I cannot guarantee that I can do that, no matter how good of an operator I am, because there's external factors that are affecting the execution of this business plan now, right?
Yeah.
What if the tenants don't leave? What if the landlord tenant board doesn't grant this or whatever happens, right? Even like non-payment of rent. If a tenant doesn't pay rent, like
no leverage.
There isn't. And now you have investors to, pay out and people to report to. It just doesn't feel good. Whereas here, like, you're dealing with an institutional sized asset, number one. And number two, there is an sort of predictability in the execution of the business plan if you're a good operator. And if you have your eyes on the ball and you got your hand on the pulse, exactly what's happening at your building every day, and there's no real reason why you shouldn't be able to execute it. And that's it. At the end of the day, when you have investor capital, you have to have that confidence in execution.
So sorry, I didn't touch on that part. I know you guys really want to talk about operation. Before we go into the fire round, let's spend 3 to 5 minutes and talk about this, the integrated operation. What does your team look like? Why do you guys are so proud of that?
Yeah, Jose. Yeah, so we have we've got about 6 staff who work for us. We have our own in-house bookkeeper, our own in-house property management coordination, project manager, and we have our own in-house contractors too who work for us, who have been on payroll.
GC kind of thing. No,
they're just general.
Yeah,
they're like, I guess you can call them GCs, but they don't. It's just two guys
basically. And so because we have so much volume, then we just kind of brought it in-house. So those primarily were helping us with our flip projects. But whenever we need them for small things here and there, we bring them to Hamilton if we need them. Yeah.
Are they all on T4?
Yeah.
Mm-hmm.
Yeah. And our bookkeeper is not T4 actually. Our bookkeeper is she's pretty much like full time, but she invoices us hourly. She works like 30 hours a week or something.
There we go.
But I think that the main thing, there's two things here. First of all, control, and second is profitability. Like the amount of savings that like we're able to run a super lean operation because everybody's in-house. Our renovations, even our flips, like the numbers that we were able to produce, I don't know if anybody who's GCing the job can produce those types of numbers and create the type of product that we were creating with the level of control that we had over everything we did. And even with our turnarounds, our units, last year, we, like I said, in the last 2 years, we've renovated like 40 units or something in-house, plus all of our turnarounds with our tenants and stuff like that. We refresh our units all the time. Like everything is done in-house. Everything is fast. It's cookie cutter. It's efficient, and it's perfect because that's how I like things. Like my units.
Yeah, definitely. Definitely. She's the asset manager and really is very detail oriented, very systems driven. That's not my strength, So I give all that.
She's a visionary, and she's an integrator.
Exactly.
We've seen that a lot. We've seen that a lot. Yes.
Yeah. So and obviously the execution is the hard part. Visionary is obviously important, but definitely I give my a huge credit to her.
Yeah. You and me, we talk. But Khadija did all the hard work. I'm gonna have a team as well. I'm just exaggerating this.
Like it's not hard. It's very difficult dealing with tenants and contractors and stuff. I mean, I do step in with a lot of some of the construction portion, but
we do work on that together for sure.
It's definitely. I mean, I'm not saying that it's been an easy road, so I don't want to paint that picture either.
Oh no, not easy at all. And yeah, we were able to do a couple new builds last year. We GC'd them ourselves. So again, like it allows you to create opportunities because you feel confident because you have a team in place. Like I can go and put an offer on a 30 unit or 50 unit building and feel confident that, hey, like I can run this, no problem. Like I have my systems, I have my guys, I can do this. So I think, like I said, control and profitability, that it really, really affects your bottom line. For us, bottom line's always been, people always love to talk about units. Oh, how many flips did you do? Did you do 5 flips? Did you do 10 flips? Do you have 150 units? Do you have 10 units? At the end of the day, look, bottom line is what's most important, right? And for us to like running a really lean, profitable business, we always set our goals ultimately in terms of profitability first, and then we work ourselves backwards from there.
That's right. You and me, you and I, we know about there's a lot of egos and how many units, even though there's negative cash flow blowing up inside, whatever, don't know how to manage the team. At the end of the day, you guys are successful because you guys are willing to put in the investment and to differentiate yourself, to have your in-house team and continue to improve on them, right? So that's a long-term way to go. And people who are not willing to make those kind of sacrifice upfront and be serious about it will always not be able to compete with yourself and myself. That's just the way it goes, right? Of course, that's assuming we're good operators and integrators first. We know what we're doing.
And the same thing applies to my US assets as well. It's although our property management is third party, but every morning we have calls with them and discussing what's going on, how many vacancies we have, going through all the KPIs. So it's that experience that we've gone through, it helps us ton in getting our new projects successful.
Yeah, you got to set the expectation right in the beginning because it's a lot harder if they already built the habits, right? So that's great. Well, we're going to take a segue and go into our fire round. So are you guys ready for the quick 5 question? Keep you guys on your toe. First question is, if you guys become a billionaire with the B tomorrow, if you guys are not yet, what will your day look like?
I think my day would look almost the same. It just might be in a different environment. Yeah. So I would be somewhere warm, probably. And I think that would be the main factor if I had billionaire status.
Where?
I don't know. I like it down south, like Costa Rica or something. Have a private school teacher, and my kids would be taken care of, and we continue to work and do our daily. Like, we love what we do.
Yeah, exactly. I wouldn't do anything different. It's mostly just probably have a lot more staff and more help. So
can you guys not do that now? I don't think you guys need to be billionaire. You guys can do that now. It might actually save some bottom line.
Yeah. I mean, luckily we do have help when it comes to, like, we have a nanny, but you know what? It's
we have our parents here. Like, I think if we moved, we'd have to kind of move people with us, or I don't know. There's a little more logistics to think through. Yeah.
Okay. Ideal. Yeah. Okay. Next question. If you guys lose all your units, 150 units, lose all your US property, you have to start over right now. You're not going to start fresh. Like, you still have your reputation. You have $500,000 that dropped from the sky. Or you do.
Yeah, I probably take it and flip it. I have to find a way to generate fast cash, which is what we've always done to kickstart ourselves. So find a mechanism to sort of utilize our skills to take that 500,000 and duplicate it or triplicate it as fast as we can.
Let's say if your kids come out and was like, "Dad, Mom, I have $500,000. Teach me."
Yeah. So like I said, for me right now, like, I would personally like just find some flips to do and start burring the heck out of them. And for me, that's always, for us, it's been the fastest way to generate more income. You can't invest in money that you don't have. And once you invest that money, I think, especially in the climate right now, it's hard to create rapid growth through real estate for us anyway. Like, that's not been the experience.
I would say my answer to that very quickly is to be able to raise capital, right? Because we have the knowledge, but if we lost everything, if we know how to raise capital, then we can always get into deals, right? So that's a very, very important skill.
Yeah, money, people, deal. You guys have the people with the experience. You guys lost all the money, but you guys can still find a good deal. And if you know how to find the money, people, deal, solve, right?
Exactly.
Yeah.
Good. Respect to him. So I know you guys are podcast hosts as well. If you guys can only pick one person to interview, who would that person be?
If I were to answer, I would say Grant Cardone.
I was going to say the same thing.
Grant Cardone. I mean, love or hate him, but I think he has some great points. I love that he has that energy. And
he's 60 somewhat year old.
Yeah,
64 years old.
And so I love that about him, that he just recently, over the last 10 years, is when he actually really blew up, right?
Yeah.
So somebody like him that never gave up and still has big dreams and is helping a ton of people, motivating it, being an inspirational to so many. I highly respect that about him.
Got it. So that kind of segue into our next question. What are the ways that you guys are giving back or planning to give back?
Yeah, I mean, I always believe that, charity starts in the home. So for us, giving back to our parents, not just with money, but with our time. We both have strategically now, our parents are within a 3-kilometer radius from our house. We've moved them close to us. It supports our kids. It supports our parents as well. We're able to be there for them, and we have the time freedom to do that. So as one phone call and we're there, doctor's appointments, whatever they need, we're there for them. That has always been really important to us. We've also helped our parents. We don't give them money, but our parents have invested their money based on some of our advice, and now they're financially free as well, which has been a huge.
Absolutely, yeah. Especially,
it's really nice to see. Like, I know people talk about like these. Of course, we do give back to. We have charities we give back to, but I think there's this like very deep intrinsic satisfaction to seeing your parents nearby and you being able to give back to them, because like your parents have done for us, we feel like our parents have done so much. Our parents were immigrants to this country as well.
An immigrant culture.
Started from nothing, watched, my parents came to Canada with $1,000 in their pocket. And, we used to sleep on mattresses on the floor when we came. Right. So for me, as much as giving back to bigger causes is obviously like a long-term thing. This for me right now at this moment has been like our biggest thing.
Gotcha. So where can our audience find more about you? What do you want to channel them to?
Yeah, no, definitely. There's multiple ways to reach out. We add us both on Instagram, Jose Jafferji and Khadija Jafferji. Our website, savvyrealestate.ca, is a great way to go get a hold of us and check us out on what we do. And
you can listen to our podcast on iTunes, the Savvy Real Estate Investor Show.
Yeah.
And if you Google us, you can probably find us.
That's right. Well, it's a pleasure. We can probably talk more. Love your energy, and too bad time flies, but we really appreciate you being on my podcast. And I think Aline will say the same for sure. So thanks a lot.
Yeah,
Thanks for having
appreciate
us,
it.
Cody. Appreciate it.
Thanks so much.
All the links mentioned in this episode are included in the show notes. And if you love this episode, please leave us a rating and review on Apple iTunes. The link is also included in the show notes. And we would really appreciate your help in spreading the word to more high income earners on how they too can maximize both their time and money.
Also, if you still haven't joined our High Income Earners Facebook group, you are missing out on High Income Earners community, where we help each other reach our own version of FIRE.